Yesterday, Bitcoin dropped after the Fed meeting, and every financial commentator in America said the same thing. Hawkish Fed means bad for Bitcoin. Rates staying higher, liquidity tightening. Move on. That is the wrong frame. Completely wrong. Here's what I know. I spent 17 years in the mortgage business, and I want to tell you about a conversation I had when I was personally earning $1.2 million a year. A bank, a real bank, offered me a $50 million line of credit. Not because I could repay it, they told me I didn't have to. By the end of this video, you're going to understand exactly why that happened and why it tells you more about yesterday's Fed meeting than anything you heard on CNBC. You're going to see the mechanism that runs beneath every dollar, every rate decision, every Bitcoin headline. And I'm going to show you exactly which side of that mechanism your money is sitting on right now. Real quick before we get into it, I built a free tool specifically for this to show you exactly which side of the transfer your money is on right now. I'll point you to it in a minute, but if you want to jump ahead, it's at timtalksfinance.com/inflation-transfer calculator. Stay with me. The setup matters here. So here's what just happened. Yesterday afternoon, Kevin Warsh, new Fed chair, his very first FOMC meeting, held rates at 3.5 to 3.75%. Markets expected that. Bitcoin dropped anyway. The Dow wobbled. And the financial media told you it's because Warsh sounded hawkish. Here's what actually happened. 9 out of 18 Fed officials now pencil in at least one rate hike before 2027. And 3 months ago, in March, the same Fed projected inflation at 2.7% this year. Yesterday, they revised that to 3.6%, nearly a full percentage point higher, in 90 days. That is not a rounding error. That is the Fed telling you, in their own official document, that everything they thought they understood about where prices were heading in March was wrong. Think about what that means personally. If you were waiting for rate cuts to lower your mortgage payment, you're waiting longer. If your savings rate was supposed to eventually start working for you, the window is staying shut. And if you've been watching grocery prices and thinking, this has to get better soon, the Fed just told you they don't think it will. Not this year. Not until 2028. Now here's the number that should stop every saver cold. Real yield on cash right now, your actual return after subtracting inflation, is 0.2%. That's it. Take the Fed funds rate at 3.625%, subtract the Fed's own inflation projection of 3.6%, and you get 0.2%. Your savings account is essentially treading water in real terms. And inflation doesn't go back to 2% until 2028. So the question the financial media isn't asking, if cash is basically flat in real terms and the Fed is stuck, where does money go? That answer starts with a $50 million offer I got in my office one afternoon. And to understand it, you need to see something about money most people never get to see. When I was in the mortgage business, I was producing volume. 2019, $1.2 million in personal income. A good year by any measure. I was originating loans through UWM, United Wholesale Mortgage. And a bank called my office with what's called a warehouse line of credit. $50 million. For people who don't know, a warehouse line is a short-term revolving credit facility that funds mortgage loans at closing before they're sold to the secondary market. I originate your mortgage. I need to fund it at closing. The warehouse line covers it. Then I sell the loan to Fannie Mae or a private investor, collect the proceeds, and the line resets. Rinse and repeat. Now here's the part that permanently changed how I see money. They offered me $50 million on $1.2 million in personal income. I said, I can't personally back that if something goes wrong. They said, you don't have to. Here's what that structure actually looks like. The bank applies what's called a haircut. They fund 98 to 99% of each loan's face value. I cover the 1 to 2% gap from origination fees I charge the borrower. That's their buffer on individual loans. But if a loan goes bad, if the investor kicks it back, there's a repurchase obligation. I'm supposed to buy the loan back. But the entire structure is built around loan volume, not my personal net worth. The system doesn't ask, can Tim personally repay $50 million? It asks, is Tim generating enough loan flow to justify the line? I saw this breakdown firsthand once. We did a refinance in Colorado, non-owner occupied purchase, 45% loan to value. Think about what that means. The property would have to lose more than half its value before the bank had any real exposure. The borrower was clean, income verified, great credit score, didn't even need the spouse's income to qualify. But the non-borrowing spouse had MMJ income, marijuana-related income. The investor kicked the loan back. Not because it was a bad loan. 45% LTV is some of the safest paper you'll write. They kicked it because their guidelines had a blanket prohibition on any household connection to that income category. Period. We had to resell it to a different investor. The risk wasn't the borrower. The risk was whether the loan fit the secondary market's rules. And here's the number that puts the scale in perspective. Warehouse lines operate at leverage ratios up to 15 to 1. A mortgage company with a few million in capital can originate $50, $60, $70 million in loans because the leverage amplifies their capacity. Volume is what drives the system, not the value any individual can personally repay. Hold that image, because this is not just how mortgage banking works. We're about halfway through, and I want to be honest with you. What I just described is a small window into a much larger machine. And once you see the full machine, the conclusion I'm going to walk you to in the second half is not speculation. It's just following the logic. Stay with me. Zoom out. Every dollar in existence was created the same way that warehouse line funded your neighbor's mortgage. Through a loan. When you walk into a bank and borrow $1,000, the bank doesn't pull $1,000 from a vault somewhere. It creates a $1,000 entry in your account. New deposit. New money. That didn't exist before you signed the note. The loan creates the money. This is not a theory. This is how commercial banks are chartered to operate, regulated by the central bank. The Federal Reserve sits at the top of that chain as the guarantor. When banks take excessive risk, as they did in 2008, the Fed backstops them. That's what too big to fail means. The system guarantees its own survival, even when individual actors inside it blow up. And what happens when the Fed has to step in? It buys the bad assets, mortgage-backed securities, treasury bonds, and the national debt grows. The money supply expands, and every dollar already in existence buys a little less. This is not an accident. This is the mechanism. It was engineered this way. Now the question is, who wins when this runs? And who loses? Because the Fed meeting yesterday didn't change the mechanism. It confirmed where we are inside the cycle. In an inflationary monetary system, there are two types of people: borrowers and savers. And they are not treated equally by this machine. If you locked in a fixed-rate mortgage between 2019 and 2022, you're in one of the best financial positions in America right now. Your debt is fixed in nominal dollars. Inflation is running at 3.6 to 4.2%. Every single month, you're paying back that loan with cheaper dollars. The real cost of your debt is quietly melting. Meanwhile, the asset, your home, is inflating right along with everything else. Fixed debt, inflating asset. The gap between those two things is where wealth gets created without you doing anything. Now flip it. If you're sitting in cash, savings account, money market, earning 3.6% on a good day, with inflation at 3.6%, your real return is essentially zero. You're not building wealth. You're running on a treadmill while the current pulls in the other direction. And here's how the mortgage machine connects to this. Banks create money through loans. Governments borrow more than any other institution in the world. $36 trillion in outstanding US debt right now. The Fed accommodates that borrowing by buying bonds and keeping short-term rates manageable. New money enters the system. It flows toward assets first: real estate, equities, commodities, things with limited supply. Consumer prices follow. Look, I want to say this directly. When Trump says he loves inflation, when Warsh refuses to cut even with real yields at 0.2%, they're not confused. The US government owes $36 trillion. Interest on that debt is already over $1 trillion per year. Every quarter point cut saves them billions. Inflation melts the real value of that debt over time. The mechanism serves the largest borrower in the world, and you, unless you own hard assets, are on the other side of that trade. If you want to know exactly which side of this transfer you're on right now, I built a free tool at timtalksfinance.com. You put in what you hold, and it shows you your real return after inflation and what the alternative looks like. Links in the description. 2 minutes. Run your own numbers. Which brings me to the conclusion, and to the thing I promised you at the start: why that $50 million offer tells you everything about Bitcoin right now. Remember the warehouse line: $50 million. They didn't need me to be able to personally repay it. Here's why. The loan itself creates the money. The system doesn't need the value to exist first. It creates the value through the act of lending. That is the machine. And for thousands of years, every single asset humans have used as a store of value has been subject to some version of that machine. Gold can be mined. Silver can be minted. Real estate, you can build more of it. Fiat currency can be printed. Bitcoin is the first asset in human history where no bank, no government, no Fed chair can create more with a keystroke. 21 million, that is the cap. Written into the protocol itself. Enforced not by any central authority, but by every node in the network simultaneously. Now here's what yesterday's FOMC meeting confirmed for that thesis. Inflation not back to 2% until 2028. Real yields at 0.2%. The Fed trapped, unable to cut without looking like they've surrendered on inflation, unable to hike without crushing an already softening economy. Supply-driven inflation from the Strait of Hormuz, which interest rates literally cannot fix. This is not a monetary policy problem anymore. This is structural, and structural problems don't resolve in one Fed cycle. In the 1970s, the last time we had sustained stagflation, gold captured the rotation out of cash. It went from $35 to $850 over the decade. Not because gold did anything new, because cash stopped working and people needed somewhere real to put value. Bitcoin is the 2020s version of that rotation, with one critical difference. Gold doesn't have a hard supply cap. Bitcoin does. An institutional infrastructure that didn't exist 5 years ago, ETFs, corporate treasuries, bank custody, now makes this trade accessible to anyone watching this video. The $160,000 projection I walked through earlier this week is not hype. It's the global M2 correlation, 0.85 over 5 years, applied to a structural Fed trap that just got confirmed in yesterday's dot plot. Here's what to actually watch from here. Watch the September meeting. If the Strait situation resolves and energy pulls back, you'll see inflation data soften. September is the earliest plausible window for the first cut. That's when the macro tailwind for Bitcoin flips. Watch monthly core PCE. If the monthly readings start decelerating, printing below the trend, the Fed gets cover. Every release matters now. Watch Bitcoin exchange reserves. In June alone, holders absorbed 125,000 BTC in a single month. The supply is thinning on exchanges. That's the on-chain signal that demand is quietly absorbing the FOMC dip. And the question, the one I started with, is not whether you understand this now. The question is, are you positioned inside the mechanism or outside it? Drop a comment right now. Homeowner on a low rate or holding cash trying to figure out the next move? I read every single one, and your answers are going to shape what I break down next. Here's the bottom line from today. The Fed meeting yesterday confirmed one thing: the mechanism is still running. The same mechanism I watched from inside the mortgage industry for 17 years. Loans create money. The money inflates assets. The transfer moves from savers to asset holders. The only variable is how long it takes. That $50 million they offered me when I made $1.2 million, I turned it down. I didn't understand the back end well enough to feel safe. But the lesson it taught me about how money actually works, worth more than any commission I ever made. If you want to go deeper on the Bitcoin thesis, how the rate path connects to $160,000, I've linked both earlier videos in the description. Start there. Before you go, if today changed how you see your cash or your savings, go to timtalksfinance.com and run the inflation transfer calculator. It shows you in 2 minutes exactly which side of this mechanism your money is sitting on, and what one change looks like over 5 years. Free. Links in the description. Next video, I'm breaking down the September meeting setup. What has to change in the data between now and then for a rate cut to come back on the table? Subscribe so you catch it when it drops. I'll see you in the next one.